Welcome to Day Trading Syndicate course. My name is Trader Hisham, and I'll be taking you through the course today. The intro, the technical analysis, the risk management, and psychology. And in the intro, I'll be covering the headlines, starting from what is day trading. I'll be covering our culture and risk trading as a business, why we day trade stocks and futures, why most people fail, and day trading components, the things that we will discuss further in this course. How to start day trading for consistent profit, how prices move in the market, and we'll talk about why we buy companies' shares and what are the interests between the companies and shareholders, just to give you an idea about what is day trading. So let's kickstart with what is day trading. Day trading is a form of share dealing in which individuals buy and sell shares over the internet over the period of single days trading with the intention of profiting for a small price fluctuation. Day trading is not an investment act. I never consider day trading as an investment, as we generate profits on daily basis. We never leave positions open overnight. So it's a trading the price changes using a margin and capitalize on fundamentals or technical strategies to generate profits in a very short term. This is what we do. It's a very short term transaction. We do through a platform or a broker who executes our orders. We buy stocks. Let's say we buy it for a low price and sell it for a higher price and make the price difference as a profit. Depends on your margin and capital that you're using for the transaction. We use this very short term. We never leave positions open, and this is why we call it a day trading. Very, very short term. Day trading is for everyone, but not everyone willing to sacrifice in order to learn. Well, my experience with day trading, it takes a lot of effort and it needs dedication. Most people usually have a capital problem or skills problem, and some people have both problems. But you have to understand, before capital and before building up capital to start investing in this category of trading, you need first to build up a skill set that will guarantee you making money over the short or long term. Because the day trading is not just execution skill. It is a psychology skill. It is a risk management skill. It is a management skill. Day trading is a business, and you have to treat it as a business. Our culture and risk. Our culture is built against taking risks. We all been taught to find safety and sustainable careers and safe investments. We have been taught to avoid risk to survive, where risk is the only way we can grow and survive. Our country is turned from leading growth and science, especially here in our Arab world countries, to followers due to the risk seeking. But some of us stand out and proved why risk is essential for us to grow. So risk here is a double-edged sword. It's like an energy. It can help you or it can shock you. It depends how do you use it. If you understand risk and you know how to manage it, it will always work in your favor. I mean, taking risk in such business, and every business has its own shaped risk, and there is stages where we define risk and how to get to manage the risk from head to toe. And I believe every business category that related to this topic has its own procedure to manage risk. And in the risk management section, we will speak briefly about this, about risk in day trading as a business. Now we'll talk about trading as a business. In order for you to start a business, first comes education. You cannot start any business without prior education that takes your learning curve from down to up, where you spend time, physical effort, and money sometimes to get this education done in the right way. So this is where most of us gain experience during college years, for example, where we invest time and money to gain an experience in a specific field. We don't call our learning curve is a loss from the time and money perspective. We never go to college and spend money and time to learn, and we call it a loss. We call it a learning curve, and this is the same thing how we should treat this field in day trading. That we need to consider our at least the first 4 to 6 months is the learning curve, including the expenses, including the time and everything we put in to do the work. It was never a loss. It's just that it's the mindset who treats losing money in the market in the first period as a loss. We use losses to extract information, to learn lessons, and then apply it later. So we don't call our learning curve is a loss from the time and money perspective. Trading requires the same investment, but people call it a loss in trading because they expect to make money from day one without proper education. Here's an example. You cannot go to a library and just read a book about making a surgery and go the second day start making surgeries. There's no same person can take such an action. Same thing with day trading. People do so. They go read a book or go to a free online source and get some information and jump in the market, and they think with this information they will be able to generate profit from day one, and that's a wrong concept. In every business, there is a short-term and long-term fees that is required to keep the business running. Same thing with trading, so we won't call the drawdowns and other expenses losses. We pay for data fees, we pay for platforms, we pay commissions for brokers, we pay for other websites to provide us with news or fundamentals, and this is all called expenses, including the risk or the losses that we pay on every trade. The cost of opportunity of every trade. This is all fees, and we consider it short-term, depends, short-term or long-term fees, but it's needed to run the business. Why we day trade stocks and futures short-term? First things first, less exposure equals less risk. The more you minimize your exposure in the market, the less risk you take. The longer you're exposed to the market, more risk you take. Of course, because market moves every minute, every second. Markets, stocks, and futures, it's moving, it's non-stop. Markets, of course, the stocks are limited from 9 a.m. to 4 a.m. New York time, but it's moving starting from the market open till the closing. Markets are moving, buyers and sellers available around the clock, especially in futures. But in day trading, we try to minimize, we try to buy it on the small moves in the market to minimize the exposure. To generate cash flow weekly or monthly. So the purpose here of day trading is to provide cash flow daily or weekly or monthly, which keeps your capital liquid all the time. We just use the buying power or the capital during the transaction, which takes from seconds to hours, but day traders should not leave any open positions overnight. Otherwise, it will put you in risk of the overnight exposure, which you cannot control. In day trading, we try to keep everything under control as much as possible. Independency, that you are independent as a day trader. You are your own management, you are the employees, you are the execution, you are you handle every single aspect of this. Of course, it requires accountability and a lot of psychological elements that we will go through in the psychology part. Work from anywhere at any time. Of course, this gives you the freedom to work anywhere, anytime. You can travel and work. You can work when you're ready. If you're not ready or you're not feeling like you cannot day trade at a specific time or a day, you're totally free to do so. So freedom here is a luxury of this field of business. Unlimited upside, of course, in the market we have strategies to limit down our risk, and we open the upside for the market to reward us for what we're doing. And of course, like any prices, there's no limit on the upside on any stocks, and this is what we try to capitalize on the market, is to let the market reward us on the risk that we're taking. And we usually look for a risk reward 1 to 3 or 1 to 4 or 1 to 5 and so on. And in risk management, we will discuss specifically strategies to let the market give you unlimited upside. You have no customers or employees to keep happy. So like any business, you always have to keep the employees happy, the customers happy, the management happy, and of course that a lot of effort sometimes, and it's a bit challenging to keep all sides of the business happy. Sometimes it's a bit tricky, but in day trading you don't have this problem. You only need to keep track of your day trading transactions. No accounting requirements. expect your daily, monthly report. So you don't need any accounting reports. You only need your personal report to show you your weaknesses and your strength end of the month, so you can improve and reduce your risk. So you're not required to do any accounting. And now most brokers, they make the report automatically, so you don't need to spend any effort in preparing that. Buyers and sellers available whenever you would like to execute trades. So you come to the market whenever you like to execute your trade on the buy, on the short side. Buyers and sellers always available for you. So that was never a problem. Why most people fail? This is where 90% or more people coming to the market to make money from day one. Some think it's a form of gambling, some think that they can master the game in no time, and some just got it emotionally as they saw their friends or relative bragging about how much they made in the markets. And some are just following false brokerage ads. Of course, especially these days, brokerages are trying to generate as much transactions and commissions. So they made these false ads, make your salary in a day, or make a 10,000, 20,000 in a week, and so on, attracting more customers. And of course, the percentage here is 90% of people fail to in the market, but right now I believe it's 98% of people fail in this business because of the misconception, or the way they come to trading is not always the right way. Day trading components, and these are the components that we will go briefly in this course material. Risk management, and risk management is where you can manage your risk and reduce your downside in the market. The edge is our basic core strategy, and we will mainly focus on the auction theory and how we trade the auction. And last, we will go through the psychology. Of course, we cannot cover like 100% of the psychology. I'm not a psychologist, but when it comes to day trading, I know exactly what I'm talking about. So we will go through day trading psychology problems and how to fix it and how to improve our skill set in this category. How to start day trading for consistent profits. First, you need an education. Education is the key for anything, and you need to find always the right source of education. Maybe sometimes you will go through a bad education system or a good education system, but eventually you are the judge according to the results that you get. Understand the trading learning curve. There is always 4 stages in trading, and first stage is when you start accumulating as much information as you can, and then stage 2, you start getting rid of most of this information, and you just keep around 30% of what you learned, what you saw working in the markets. And then stage 3, you're spending physical and mental effort to follow the procedure and do it right, and trying to stay on the right way. And stage 4, where you execute effortless, when your execution and process come effortless in the market without even thinking. It's just like driving. The first week you start driving, you start thinking about the key, about the wheel, about the gas, about everything, every action you do. But after 1 or 2 years of driving, you don't even think about it. You just it comes as a muscle memory. You can eat, drink, and sometimes speak on phone. This is the 4 stages of the learning curve, and you have to expect yourself going through this learning curve. But with proper education, we can reduce the time frame of this learning curve from years to just a couple of weeks. Accountability. You have to be accountable for your actions. So in trading, you have no management. You're not accountable for anyone. There's no management ahead of you. So doing this job on top of your execution, that's a bit tough psychologically. So this process usually takes time, more than learning the technical or risk management, but it's doable. And the more you focus and the more you set clear goals every month, the less time this kind of skill set will take. Your attitude, you cannot come to the market with an attitude of I lost my money, the market took my money, the broker took my money. This kind of attitude doesn't work. The market is just a mechanic that brings the buyers and sellers together, and it runs with the chaos theory. And your attitude towards the market should not be market is taking my money. Attitude here is very important. You have to know that this day trading field is like any other business, and you have to treat it as a business and be responsible for your own actions. Development and growth process. You have to, after you develop a good strategy and after you have a consistent profit, you have to work always on development and growth. Always work on reducing your risk, maximizing your profit, see what's your fits your personality, what's you're comfortable with in trading, and this development process keeps going on, and this is what sets professional traders apart from amateur traders. In this section, we'll talk about how prices move as a basic element of our core strategy. You have to understand how the markets move up and down. So what you see here is the price ladder. In the middle here, you see an example price. On the left side, you see the bid size, which we call the buyer's section. On the right side, you see the ask size, which is the seller's section. And the numbers here representing the size is waiting at this price. What does it mean? On the seller size here, you can see 6 waiting. So let's speak in shares. We have here 6 shares waiting to be sold at $11. So that we call a limit order. At price 10, we have 10 shares waiting to be sold, and this is the waiting sellers at price. And the opposite here at the buy sides, these are the waiting buyers at prices. So what exactly moves the market? Limit orders and these waiting orders never moves the market. What actually moves the market is the aggressive buyers or the direct market order buyers, which we will go explain briefly in the next section, which is the technical. But how prices move here? In order from the price to move from 10 to 11, we as traders or direct market orders, we have to take out these 10 shares from the sell side. So we actually have to buy these 10 shares, and any extra amount need to be bought. The market will move us from 10 to 11 to provide what we need. So let's say I'm a direct market buyer and I want to buy 12 shares. Market price now standing at 10. So first, market will fill me with the 10 that I want. And then I gave an example of, let's say 12. Yes, I said 12. I actually lost it. Let's say it's 12 that I need. So at price 10, I will fill this 10 on the ask size. And in order to fill 2 more shares for me, the price have to move up to $11 and fill my last 2 shares from $11, because these are the sellers available in the market to buy from. On the other hand, on the sell side, on the buy side, in order for the price to move from 9 to 8, direct market sellers have to come and fill this out. There's a buyer here, so in order to people want to buy, need something to sell for them. So we need sellers to come and fill this 7. Let's say I'm a direct market seller and I want to sell 10 shares. So first I will come to price 9, I will sell 7, and then price will move down and then fulfill my rest of my position. And if I have bigger position, market will keep moving down to fill my order as a direct market seller. This is how prices move. So in order for price to move from 10 to 11, direct buyers have to remove the 10 sellers at the 10 USD price. In order for price to move from 9 to 8, direct sellers have to remove the 7 buyers order at 9. So market moves in the most active side direction. If the sellers are active, price goes down. If the buyer is active, price go up. Why we buy company shares? Why these transactions? Why companies sell their shares? By buying a stock, you are exchanging cash value in return of a company share ownership through one of the stock exchanges. This allows company to expand and shareholders to grow their investment as long as the company maintain growth and value. So we're sharing benefits here with the company. I'm using the company value to grow my asset. The company using my cash and liquidity to grow and to grow in products or in services, and we benefit from each other, and this is the main reason why we buy companies shares.